We're diving into a real paradox today. For, centuries, the insurance industry has run on this fundamental conflict of interest.
Right.
They make money when you don't file a claim, and that just creates this, adversarial relationship, a huge trust problem.
And that's exactly the crack in the foundation that's letting something new grow. We're looking at a space called P2P, or peer-to-peer insurance.
Okay.
And it is projected to grow at just a staggering 32% compound annual growth rate.
32% in insurance. That's unheard of.
It really is.
Yeah.
That kind of growth in a sector that's been basically static for hundreds of years, it means something big is happening.
It does. I saw the market value was around $63 billion in 2023.
63 billion, yeah.
That kind of speed proves that people are desperately looking for an alternative. The whole promise is that P2P flips the script. If there's money left over, you get it back.
And that's the core question we need to unpack in this deep dive. Is this explosive growth just, hype? Or does P2P actually give you better, safer, more trustworthy coverage than what you probably have right now?
Right. We're going to give you the blueprint, then the data, and maybe most importantly, an actual checklist to see if it's right for you.
Let's do it.
Okay, so part one, let's unpack the blueprint, the mechanics. People call it the village model reborn, which sounds nice, but how does it actually work?
It's all about scale, or rather the lack of it. You join a small pool, maybe with friends, maybe just people with a similar risk profile.
How small are we talking?
I think 10 to 50 people, not millions. And everyone contributes their premiums to that shared pot of money. That pot is what pays out the claims.
So the P2P company isn't the one on the hook for the risk.
Exactly. They act more like a manager. They manage the funds. They process the claims with AI. And then, and this is the key, the leftover money goes back to the members.
Okay, that makes sense. But how does that leftover money actually get split? I've heard there are a couple of very different ways they handle that.
You're right. There are two main models. The first one is the really straightforward refund model. A company like Friendsurance pioneered this.
And that is what it sounds like.
Pretty much. If your group has a good year, not a lot of claims, the unused money is literally given back to you.
As like actual cash?
Yep, cold hard cash in your bank account. Or sometimes they roll it over to lower your premium for the next year. It's a direct financial reward for being safe.
So if I pay $1,000 in premiums and the pool only uses $600, I could see some of that $400 difference back in my pocket.
That's the idea. It's a powerful incentive.
Yeah.
Then you have the second model, which is maybe even more interesting psychologically.
Okay.
It's the lemonade give back model.
I've heard a lot about this one.
So here, the company takes a flat fee right off the top, say 20%. That covers their costs, their salaries, their reinsurance. And they draw a hard line. They do not profit from denying claims.
If they don't profit from it, what happens to the money that's left over?
It gets donated. The group members vote on a charity at the beginning of the year, and all the surplus funds go straight to that cause.
Ah, okay. So this creates what they call the behavioral lock.
That's the term, yes. It's brilliant, really. Because now, if you think about padding your claim for an extra couple $100, you're not stealing from some faceless corporation anymore.
You're taking money away from the local animal shelter your group chose.
Exactly. It's socially unacceptable. It's amazing how that changes behavior. For filing an inflated claim against a giant insurer, for a lot of people, there's almost no moral hang-up.
But doing it to your peers or a charity, that feels totally different. And you said the data backs this up.
It does. Pools that use this kind of social underwriting, they often see fraud rates drop by as much as 30% compared to the industry average. And none of this would even be possible without the tech. This is a technology play, first and foremost. You've got AI for instant claims and blockchain for transparency.
Okay, that's a perfect transition. Let's pivot to part two, the data duel. That 32% growth rate has to be coming from somewhere. What are the actual verifiable advantages driving this?
It's really a perfect storm of three things. First, that trust deficit we talked about. It's created a huge pent-up demand for something transparent.
People are just fed up.
They are. Second, the tech is finally there, mobile, AI. It makes this kind of communal model practical in a way it never was before. And third, you have the sharing economy.
Like Uber or Airbnb.
Exactly. Those companies normalize the idea of trusting peers, of relying on a platform instead of a big old institution.
Let's drill down on the biggest draw for consumers, though, the cost savings. If P2P is cheaper, Where is that money coming from?
It's coming from cutting out the middleman. Traditional insurance is loaded with bureaucracy. You have brokers, agents, massive sales departments. All of that drives up administrative overhead.
Which eats into your premium.
It does. We're talking 20 to 30% of your premium dollar just gone to overhead. P2P models slash that. They streamline everything, bringing those admin costs down to maybe 5 to 10%.
So if you remove 20% of the friction, does the customer actually see 20% in savings?
Often, yes. Sometimes more. The data we've seen shows average savings between 20 and 30% compared to traditional policies.
Do you have any specific examples?
Sure. Lemonade famously offers renter's insurance starting at like $5 a month, which is almost unbelievable.
$5.
And we tracked a case study of a driver in Austin. He went from a $125 a month traditional policy to a $98 P2P policy.
So an immediate saving.
An immediate saving. And then, at the end of the term, he got a $75 refund back. All told, he saved nearly $400 in 1 year.
Those numbers are really hard to argue with. But, you know, cost isn't the only pain point. It's the claims process. That's where people really hate their insurer.
Oh, absolutely.
Waiting weeks, months, endless phone calls. How fast is P2P, really?
This is where the AI completely changes the game. For simple, straightforward claims, P2P platforms use algorithms to approve them almost instantly.
I have to ask about the famous one. Lemonade paid a claim in 3 seconds.
They did. It was for a stolen coat. The AI processed the user's video claim, cross-referenced the policy, ran it through fraud checks, and triggered the payment. 3 seconds.
Okay, wait a minute. 3 seconds sounds like a great marketing headline. But is that realistic if I, say, total my car or have a house fire?
That's a fair challenge, no. A major complex claim that needs a human adjuster on site is still going to take time, but the digital process speeds up everything before that human gets involved.
So all the paperwork and back and forth is faster?
Dramatically faster.
Yeah.
And these platforms pioneered things we now take for granted, like enhanced image uploads from your phone and automatic collision reports. It just cuts out so many steps.
And consumers are noticing. We've seen the data. Overall satisfaction with digital claims hit 871 out of 1,000 points in 2024.
Which is huge.
It's the first time digital has ever beaten phone-based systems for satisfaction. That's a massive shift.
It is. And it all comes back to that foundation of trust, which is enabled by technology like blockchain.
Right. Let's talk about blockchain. It's a word everyone throws around, but what does it actually do here to solve that trust problem?
It creates what you could call radical transparency. Blockchain is basically an unchangeable public ledger. Every premium payment, every claim, it's all recorded in a way that can't be secretly altered by the insurer later.
So no cooking the books.
Exactly. It eliminates that core suspicion that the carrier is hiding money or manipulating the numbers to avoid paying out. With many of these platforms, you can literally see in real time how the pool's funds are being used.
Okay, so we've established why it's booming. It can be cheaper, it's definitely faster, and it's way more transparent. It sounds incredible.
It does sound incredible.
Which means it's time for the reality check. Let's move to part 3, the trade-offs. This model can't be a perfect fit for everyone. What are the structural risks people need to know about?
This is maybe the most important part of the conversation. The single biggest risk is what's called risk pool stability, or, as finance people call it, the law of small numbers problem.
The law of small numbers. Break that down for us.
Okay, think about it like this. A huge traditional insurer has millions of customers spread out all over the country, all over the world even.
So their risk is massively diversified.
Massively. If a hurricane hits Florida, it's a huge event, but it doesn't bankrupt them because they're still collecting premiums in California and Texas and New York. A small P2P group of, say, 50 people in one town doesn't have that protection.
So one big localized event, a hailstorm, a wildfire, a flood, could hit a large portion of the people in my small pool all at once.
And it could wipe out the entire pool's balance for the year. The volatility is the vulnerability. If the claims are more than the premiums collected, the pool's in the red.
So what's the safety net? What stops the whole thing from collapsing?
Reinsurance. This is critical. Reinsurance is basically insurance for insurance companies. All legitimate P2P platforms buy it. It's a backup policy that kicks in to cover massive losses and ensures that your claim still gets paid even if your local pool runs dry.
So you have to check that reinsurance policy.
You have to.
Yeah.
You have to check the financial strength rating of the company providing that reinsurance. It's your ultimate protection.
That makes sense. Okay, so that's a big one. What's the second major trade-off?
Accessibility. And this comes down to regulation.
Right. Insurance is regulated state by state, and these laws are old.
They are. They were written for huge centralized companies decades ago. A lot of P2P models just don't fit neatly into those rules. This creates these regulatory gray zones.
Which means they can't operate everywhere.
Not even close. It creates huge geographic limits. Take Lemonade car insurance, for example. It's one of the most popular products. But as of now, it's only available in about 8 states.
Only 8. So for most people in the country, it's not even an option.
It's not. Especially if you live in a rural area where there just isn't enough population density to form these kinds of risk pools in the first place.
And the third limitation you mentioned was coverage depth. What if my needs are complicated?
Then P2P is almost certainly not for you.
Okay.
These platforms are great for simple personal stuff. Renters, a single car, maybe pet insurance. But if you have, say, a high-value art collection, a small business, multiple rental properties...
I need a more specialized policy.
You do. You need commercial liability, an umbrella policy, high coverage limits. Traditional carriers still own that space because they have the experience and the scale to handle those complex risks. P2P platforms often cap their coverage, sometimes as low as $50,000 or $100,000 for certain things.
This brings us to the really actionable part of this deep dive then. P2P is clearly not a one-size-fits-all solution. So how does someone listening right now know if they should even consider it?
We can build 2 very clear checklists. You need to know which profile you fit.
All right, let's start with the ideal person for this. You should choose P2P if. What?
1. You're a low-risk individual. You're a safe driver with low mileage, a clean record. You're a renter. You're the person who is most likely to get that refund at the end of the year.
Okay.
2, you are tech-savvy. You're completely comfortable managing your entire policy, from buying it to filing a claim, through a mobile app.
No talking to a person.
Minimal talking to a person, yes.
Yeah.
3, you really value that transparency and the idea of either getting a refund or having the surplus go to a charity you care about. And finally, your needs are simple. Basic car, renters, pet insurance. Nothing complex.
That's a very clear profile. Now, on the flip side, who should absolutely avoid this, at least for now? You should stick with traditional if.
You should stick with traditional if you have complex, high-value assets, multiple cars, a home, rental properties, a business, any of that.
Got it.
Also, if you're considered high risk yourself, you've got tickets, accidents on your record, it'll be very hard to find a P2P pool that will even accept you.
What?
If you value the stability and, frankly, the long track record of a giant insurer like a State Farm or a Geico, and critically, if you want a person, you want a local agent you can sit down with face-to-face, P2P is not for you.
That lays it out perfectly. So the final verdict here seems to be that P2P insurance, even with that insane 32% growth, isn't going to kill the traditional model.
Not at all.
It's an evolution. It's expanding choice and creating competition, especially for younger, digitally native, low-risk people.
That's it, exactly. And here's the final thought I want to leave you with. Even if you went through those checklists and said, nope, P2P is not for me, you are still winning because of it.
How so?
Because the P2P companies have scared the big traditional carriers. All of that speed, that transparency, the great mobile apps, the legacy players are being forced to adopt it all to compete.
So my traditional insurer's app is better today because Lemonade exists.
100%. You are getting faster claims and a better digital experience from your old school provider because P2P pushed the entire industry forward.
It's a true convergence then. We're probably headed for hybrid models.
I think so. Models that take the tech and transparency from P2P and combine it with the massive scale and stability of traditional reinsurance. And you'll see more automation with things like blockchain and smart contracts, handling even major claims in the future.
So the smartest thing you can do right now
is shop both. Always. Get a quote from a traditional carrier and a P2P platform. And don't just compare the price. Scrutinize the coverage limits, check the financial strength rating of the reinsurer, and make sure it's actually available and regulated in your state.
Visit the links in the description below to learn more and for amazing offers.
Thank you for joining us for this deep dive.